Silver didn't climb last night, it detonated, blasting through price levels in a way that signals something far deeper than ordinary trading. This wasn't gradual appreciation. This wasn't technical breakout territory. This was raw, unfiltered market force that left traders frozen at their screens, wondering if the numbers were even real. And here's what should genuinely concern you. This movement doesn't carry the fingerprints of random chaos. It carries the signature of coordinated retreat, multiple giants stepping backwards simultaneously and accidentally triggering an avalanche. Before we dive deeper, if this analysis helps you understand markets better, please subscribe. Your support genuinely matters more than algorithms suggest. It's early morning, still dark outside, and I'm already processing what unfolded overnight. Drop a comment telling me your time zone. I'm genuinely fascinated by how global this community has become. Also, stick around until the end because there are exclusive resources waiting in the description, including premium group access and membership opportunities. Now let's dissect exactly what happened, why it matters enormously, and why the critical question isn't about winners, it's about survivors. Because here's the truth. If you're viewing this as merely chart analysis, you've already fallen behind the curve. During overnight sessions, silver launched from lower levels and simply refused to pause. It pressed relentlessly upward into triple-digit territory that seemed theoretical just weeks ago. Meanwhile, as Asian exchanges opened, Shanghai didn't just participate, it sprinted ahead. Prices there printed significantly above American futures before retreating. The gap between these markets tells the real story. Here's the simplified version. When Shanghai pays substantial premiums over American pricing, it reveals concentrated physical demand and genuine urgency in that region. When that premium compresses, two scenarios typically emerge. Either purchasing momentum fades, or American prices get pulled higher to close the gap. Last night's sequence was unmistakable. Asia ignited the spark. The premium expanded dramatically. Then something interesting happened. The premium started narrowing, but purchasing didn't evaporate. American prices climbed into it. That detail matters because this isn't simple contagion between markets. This is one market dragging another forward by force. Now you already know the predictable response. Everyone hunts for villains. Everyone searches for single explanations. Everyone needs narratives compact enough for social media. So you're encountering two dominant theories. One group claims a major American financial institution faces existential problems, trapped positions, catastrophic exposure. The other group insists China faces the squeeze, desperate for physical metal, punished by scarcity. Those narratives cannot simultaneously hold true in their simplest forms. If one party suffers deliberate crushing, the opposing party typically benefits. That's how the internet prefers reality. Heroes battling villains, clear winners facing obvious losers. But markets rarely deliver cinematic clarity. So here's my interpretation, and if you stay with me, I'm connecting silver, copper, petroleum, and strategic minerals into one uncomfortable mosaic that almost nobody wants to acknowledge. When everyone hoards simultaneously, markets don't wait for permission. They erupt. I believe we're witnessing defensive positioning, massively defensive positioning, by multiple participants simultaneously. Not orchestrated squeezes, not supply attacks, not chest-beating competitions. A collective awakening that in a world where supply chains face sanctions, rerouting, or complete disruption, waiting for inventory is gambling. You secure resources, you accumulate reserves, you lock supplies away, you accept painful prices because the alternative terrifies you more. That's the fundamental distinction between speculators and genuine consumers. Speculators obsess over price. Genuine consumers obsess over availability. And currently, availability dominates the battlefield. Let's examine who faces immediate damage because that reveals what's authentic. At corporate levels, silver at current valuations creates nightmares for numerous industries. Solar manufacturing stands prominent. Silver components are essential in photovoltaic technology. Even when manufacturers reduce silver content per panel, scale devours those savings. When silver surges, costs surge. When costs surge, margins collapse unless demand intensity allows price pass-through. So, if you're operating solar production facilities and witnessing this behavior, you don't wait hoping for corrections. You make urgent calls. You accelerate purchases. You secure whatever supply remains accessible. Identical scenarios unfold for electronics, certain medical applications, and countless industrial uses that people forget because they lack glamour. And here's something building for years that demands attention. Industrial silver demand doesn't require majority status to control market direction. It simply requires short-term inelasticity. If factories must have silver to fulfill contractual obligations, they pay whatever's required. That purchasing doesn't request permission. Based on recent industry data, industrial consumption runs in the hundreds of millions of ounces yearly. Even minor supply disruptions create devastating bottlenecks. That explains why sudden price spikes often originate from users, not investors. Consider something fascinating. For years, conventional wisdom assumed investment demand would anticipate industrial demand, public stampedes preceding industrial reaction. But what if that relationship already reversed? What if industry now front lines ahead of the public because industry has no alternative? If that's reality, typical sell the spike strategies become dangerous because support underneath prices isn't speculative capital, it's procurement departments. And procurement departments don't respect your technical levels. Now, where does that leave financial institutions? Here's where complexity multiplies. In American markets, much of the silver ecosystem flows through financial infrastructure, futures, options, clearing operations, bullion desk activities. When markets snap higher violently, anyone holding substantial short exposure, whether hedges, structural positions, or supposedly safe arrangements, experiences stress. Does that mean specific institutions face imminent collapse? I won't feed you that certainty. People love pointing at individual logos declaring guilt, but genuine market stress rarely delivers theatrical villains. What I will state is this. If you're a substantial financial institution depending on orderly markets and silver starts moving like speculative frenzy, but backed by industrial fundamentals, you're not celebrating. Even if you can trade around volatility, disruption exacts costs. You might profit from volatility. You might hedge effectively. You might shuffle exposure tactically. But when infrastructure becomes congested, the entire system pays taxes. Pain can exist on opposing sides simultaneously. Nobody requires victory for everyone to suffer. Here's what most observers miss. Damage can occur across multiple fronts simultaneously. China can suffer because their industrial foundation absorbs higher input costs. American institutions can suffer because their positioning and market-making functions face strain. Neither needs victory. Both might simply be minimizing damage. That's why I characterize this as defensive. Now expand your perspective because this is where chart analysis transforms into geopolitical disguise. Consider the broader resource chessboard. Strategic minerals, critical metals, copper, petroleum, silver. These aren't merely commodities, they're leverage instruments. Recent years revealed nations treating supply chains as strategic weapons. Export controls proliferated, sanctions multiplied. Shipping corridors became political narratives. Nations constructed stockpiles not because they enjoy capital immobilization, but because disconnection terrifies them. So here's the uncomfortable possibility. Silver is being absorbed into that reality. Not because silver uniquely matters, but because silver occupies the intersection of currency, industry, and national security. If you can control material flows from specific regions, you can influence behavior of whoever needs those materials. And South American mining zones represent crucial puzzle pieces. Silver production concentrates heavily in specific countries and geographical zones. Supply routes, refining capacity, shipping logistics, financing mechanisms. Those are choke points. And when major powers compete for influence in identical neighborhoods, supply chains harden. In practical terms, participants attempt to secure whatever they can access. If one faction believes access will tighten, they purchase early. If opposing factions believe access will tighten, they also purchase early. That's how price explosions occur without masterminds. Everybody hoards, everybody retreats, everybody tells themselves it's temporary, and then the market disagrees. Now let me explain why the Shanghai Premium and its overnight movement matters so significantly, because this is where many observers get deceived. When two major exchanges trade identical metals at different prices, arbitrage typically narrows gaps. Traders purchase cheaper metal, sell richer metal, and profit from spreads until convergence occurs. That's textbook efficient market behavior. But arbitrage functions only when physical metal can actually relocate. If export regulations, shipping delays, financing costs, and delivery constraints obstruct physical inventory movement from origin to destination, then spreads don't close according to theory. They close the difficult way. Cheaper markets get pulled upward because buyers with urgent needs will pay almost anything to avoid explaining shutdowns to superiors. That's why persistent premiums function like warning indicators. They suggest constraints aren't merely paper, they're logistics, they're availability. It's the difference between owning price exposure and owning actual bars deliverable on schedule. And here's the cliffhanger within that cliffhanger. If constraints are logistical, you don't resolve that with price dips. You resolve that with time. And time is exactly what panicked buyers lack. So when someone confidently asserts spreads will close, your next question should be, close how? Through metal flowing or through price repricing? Because those represent vastly different outcomes. Now, another element people underestimate. Silver doesn't behave like petroleum where production can accelerate quickly. Substantial silver supply emerges as byproduct from mining other metals. That means even if silver prices skyrocket, you can't simply switch on new supply next month. Mining operations plan years ahead. Ore grades decline. Permits require forever. Energy costs factor heavily, and many projects don't advance unless primary metal economics also function. Recycling contributes, but recycling has ceilings. You don't extract silver from every device because it's not always economical, and because it's distributed in tiny quantities across millions of products. That means markets are more fragile than appearances suggest when demand surges. So if industrial buyers decide against gambling and investors decide they want protection, the same ounce gets pursued by two different motivations. That's where prices can overshoot dramatically. Now, I'm going to challenge one popular oversimplification I keep encountering. Many people treat this as simple competition between superpowers, where one side can outspend the other indefinitely and the opponent eventually surrenders. That's too clean. Yes, America has enormous financial flexibility, but commodity inflation acts like boomerangs. If you squeeze input sufficiently, you also raise costs for your own systems, especially in worlds where manufacturing, defense, and infrastructure still require identical raw materials. So the smarter framework isn't who can outspend whom, it's who can absorb secondary consequences without breaking critical systems. Because if silver is surging, copper is tight, energy is volatile, and interest rates are doing their own dance, stress doesn't stay contained. It spreads. And this explains why I keep returning to the same question: who benefits and who suffers? At corporate levels in Asia, high silver is punishing for manufacturers surviving on thin margins. At corporate levels in America, stress appears in financial layers: trading desks, risk management, clearing mechanisms. At governmental levels, Asia generally wants to avoid imported commodity inflation that undermines manufacturing competitiveness. And at governmental levels, America has more tolerance for volatility because economic structure differs and currency systems cushion shocks in ways most nations don't enjoy. That mismatch matters enormously. Now add another layer. Recent policy updates show governments becoming more vocal about critical minerals, and we're seeing language that sounds less like free trade and more like strategic reserves. When that tone shifts, private participants don't wait for legislation to pass. They move immediately. They purchase. They stockpile. They negotiate long-term contracts, and spot markets become victims. So when you see silver gap and surge like this, you need to ask, is this speculative fever or scramble for physical availability? Because if it's the second, the next phase isn't gentle pullback. The next phase is rationing by price. Now, many viewers ask me what to watch next. Here are the indicators. Watch spreads between major regional markets. If they stay elevated, urgency remains. If they compress while prices keep rising, it suggests higher-priced markets are still purchasing and lower-priced markets are being pulled. Watch behavior after initial shocks. Does silver immediately mean revert, or does it hold gains and build new foundations? Genuine shortages don't unwind in days. Watch industrial headlines, not the sensational pieces, the boring ones, the ones about procurement, inventories, and production adjustments. And watch what happens around other critical materials. Silver doesn't exist in isolation. If copper is firm, if energy is choppy, if certain niche metals are spiking, that signals broader tightening is being priced. Now, if you want to read this market seriously, you must separate paper demand from physical stress, because they appear similar initially and then diverge in ways that can make you either very wealthy or very confused. Paper demand occurs when prices move because positioning changes. Shorts cover, funds rebalance, options dealers hedge. It's fast and can reverse fast. Physical stress occurs when systems start asking questions like, where are the bars? How long for delivery? Who actually holds clean title? When that happens, markets stop behaving like charts and start behaving like supply chains. One of the simplest indicators is inventory classification. Publicly available exchange reports often split warehouse stocks into categories that sound boring but matter enormously. Some metal exists in systems, and some metal is actually available for delivery. Those aren't identical. Large inventory figures can look reassuring until you realize most of it isn't moving without battles, or it's already committed, or it's pledged against other obligations. Another indicator is open interest behavior during rallies. If prices are surging and open interest collapses, that can mean short positions are being forced out, or that markets are reducing leverage because risk managers are tightening controls. If prices are surging and open interest stays elevated, that can mean new capital is entering and squeeze potential isn't exhausted. And then there's the quiet stuff that almost nobody discusses on camera because it sounds too technical. Lease rates and backwardation. When metals trade in backwardation, markets are basically saying, I'll pay more for it now than later. In normal times, people prefer paying later. In stress times, people pay for immediacy. It's not magic, it's urgency. Lease rates tell similar stories. If borrowing silver becomes expensive, it hints that someone is willing to pay for short-term access because they need inventory today, not next quarter. None of these indicators are perfect, but when several start singing identical songs simultaneously, that's when I sit up. And here's the unsettling reality. Markets can look liquid, right until the moment they don't. Silver is famous for that. It trades like it's deep until a handful of large buyers decide they want actual metal. Then, deep markets suddenly feel shallow. Not because silver vanished, but because free supply was never as substantial as paper claims suggested. So, if you're waiting for neat explanations in tomorrow's headlines, you might miss the real story unfolding in the plumbing today. And if you think the movement is over because it already happened, ask yourself this: what happens if this is only the first wave of securing supply, and the second wave starts when the public finally realizes shelves are being cleared? That's the moment I'm watching for. Now, let me pause and make this practical. If you're seeing success, share your story in the comments so others can stay motivated. And here's a question for you. Do you think this silver movement is mostly industrial panic purchasing or mostly financial positioning unwinding? Drop your answer in the comments because I'm genuinely interested in what you're observing. All right, now let's do the morning overview style because numbers matter, but relationships matter more. Yields on benchmark treasuries are modestly lower today. The dollar is softer. Equity indexes are mixed but leaning positive. Volatility is elevated. That combination, stocks up while volatility rises, doesn't signal everything is fine. It signals someone's paying for protection. Gold is surging, pushing decisively through major psychological levels and holding above them. Silver is the headline, sitting around elevated levels with strong percentage gains overnight. Shanghai silver is still at premium, even after cooling from peaks. Copper is higher, petroleum is off slightly, natural gas is elevated, digital assets are higher. Some other precious metals are climbing as well. Grains are mixed. Now, here's the cliffhanger. If this were simply risk on, why is gold acting like the world is burning? Exactly. That's why you can't look at single charts. Now let's get to the larger stories that explain why gold and silver are both acting like they're being repriced, not traded. First, there's a macroeconomic framework circulating that compares current conditions to mid-1970s environments. Large fiscal spending, intervention risks, and the possibility of inflation returning in waves instead of one clean cycle. And if you weren't investing back then, here's why that comparison frightens people. In the mid-70s, inflation didn't march in straight lines. It came in bursts. Policy tightened, the economy slowed, everyone declared victory, and then prices re-accelerated when stimulus and energy dynamics collided again. Markets swung between growth is back and we're breaking the currency faster than most portfolios could adjust. During that era, gold didn't behave like a sleepy hedge. It behaved like a stress gauge. When confidence in policy wobbled, gold responded. When real interest rates dipped, gold responded again. And commodities, especially those tied to industry and energy, tended to follow because the world was still building and still consuming, even through the chaos. That's why second-wave ideas matter. If inflation returns in pockets, you can see moments where stocks look fine on the surface, while purchasing power quietly erodes underneath. That's a perfect recipe for metals to move before the public understands why. And it also explains why silver can go from ignored to unavoidable in a heartbeat. Silver is tied to growth and tied to protection. It's a dual-purpose asset. When the world feels stable, people focus on it as industrial input. When the world feels unstable, people suddenly remember it has monetary history too. So, if this really is a wave environment, the question isn't whether volatility goes away. The question is whether volatility becomes the default setting. The takeaway from that framework isn't hide and cash, it's rotate. Stay exposed to growth, but shift where you're exposed. Less concentration at the top, more diversification across the middle and the edges. In bonds remain question marks until long yields convincingly break one way or the other. Now, I'm not telling you that history repeats exactly. It doesn't. But it rhymes enough that it changes how large capital thinks about hedges. And that leads to the second story, how macro risks actually behave. Here's the reality. Large institutions don't usually lead trades with press releases. They join after movement is already occurring because they need confirmation and cover. So when you start seeing broad convergence around gold as the hedge of choice, that can mean one of two things. It can mean the trade is crowded and vulnerable, or it can mean the regime is changed and the crowd is late. Which is it? That's what we're going to find out. And silver is acting like it already knows the answer. Third story. The drumbeat around physical gold custody and repatriation is getting louder globally. When countries start asking questions about where their gold is held and how quickly it can move, that's not a retail story. That's a trust story. And trust stories don't end quickly. Fourth story. There's fresh policy momentum toward building or expanding critical mineral stockpiles with serious funding attached. That matters because it signals official recognition that supply chains are strategic, not just economic. And if governments are stockpiling, private players are already stockpiling. That's the pattern. Now, let's talk silver targets in reality, because I know some of you are thinking, okay, is this the top? Is this the blow-off? I'm not here to pretend I can call the exact tick. What I can tell you is this. When markets rip like this, it creates two risks. The first risk is obvious. You chase it, it pulls back, you panic. The second risk is sneaky. You assume it must pull back, you sit it out, and it never gives you the entry you wanted. So instead of playing fortune teller, focus on structure. If silver can hold chunks of this movement, consolidate, and then push again, that's not blow-off, that's repricing process. And there's another angle people ignore. Above-ground inventories are not infinite. There's difference between silver exists and silver is available at scale, deliverable, and unencumbered. Lots of silver is tied up in long-term holdings, industrial products, or financial claims. The free float can be thinner than people think. That's why sudden surges happen. Now, let me keep my promise and connect silver to copper, petroleum, and strategic minerals. Because if you're only watching silver, you're missing the bigger play. Imagine a world where strategic mineral supply is restricted, where certain critical inputs get weaponized through export controls, and where energy becomes a bargaining chip. Again, in that world, nations don't negotiate politely with press conferences. They negotiate through pressure points. If you can squeeze supply chains, you can change behavior. And Latin American mining regions are huge pieces of that puzzle. Silver production is heavily concentrated in certain countries and regions. Supply routes, refining, shipping, financing, those are choke points. And when global powers start pushing for influence in the same neighborhood, supply chains get hardened. In plain English, people try to lock up what they can. If one side believes access is going to tighten, they buy early. If the other side believes access is going to tighten, they also buy early. That's how you get price explosions without masterminds. Everybody hoards, everybody retreats, everybody tells themselves it's temporary, and then prices disagree. Now, quick reminder, we have members-only content on this channel. They're produced by separate teams with more research and deeper dives, and they're only for premium members. If you want that extra layer, the join link is in the description. Also, if you're successful, share your success story in the comments so others can stay motivated. Now, let's address the China squeeze idea in a more nuanced way. Could China be desperate for silver? Sure, industrial demand plus strategic stockpiling could create urgency. But the bigger issue is this. Even if China can afford to pay, paying is not the same as solving the problem. If supply lines are insecure, price is only one part of the equation. If you need metal on schedule, delivery matters. If you need metal routed through certain channels, access matters. And if you're worried that access could tighten, you buy earlier and more aggressively, which ironically tightens access for everyone else. That's the trap. Now, the US institution blowing out idea. Could parts of the financial system be stressed by sharp movement? Absolutely. High leverage and sudden repricing are a nasty mix. But again, markets don't need single institutions to fail for prices to run. It just needs the perception of tightness, the fear of being short availability, and the reflex to secure supply. So my third view remains. Multiple players are getting squeezed by the same reality, not by each other. And when everyone starts acting in self-interest at the same time, price becomes the referee. Now, one more thing, and this is what I want you to remember. When headlines get loud, spreads and gaps are signs of disorder. When one market gaps and another doesn't, it tells you where panic is concentrated. It doesn't prove collapse. It just shows the buyer at the margin. Right now, Asia looks like the buyer at the margin. And here's the next cliffhanger. If the buyer at the margin is willing to pay up even after the spike, what happens when the public finally notices? That's when things get interesting, because retail doesn't lead every move. But when retail arrives late, it can turn repricing into frenzy. So, what would make retail notice? Simple. Headlines, price screens, and the feeling of, I missed it. That's why I'm telling you now, don't get hypnotized by the day-to-day. Watch the structure, watch the spreads, watch the physical indicators, and watch policy. Now, let's touch on the broader market backdrop again because it's tied to this. When the dollar weakens and yields drift, precious metals tend to catch bids. That's normal. What's not normal is metals moving like this while the world is still pretending everything is stable. Gold above major round numbers tells you somebody wants insurance. Silver surging tells you the insurance premium is being repriced. Copper firm tells you the real economy still needs inputs. Petroleum staying volatile tells you energy isn't a solved problem. And when you combine all of that with policy chatter about stockpiles and supply security, you get markets that stop behaving like spreadsheets and start behaving like battlefields. Now, I want to give you one more question to drop in the comments. Do you think the next shock comes from supply disruption or from financial stress in paper markets? Which one is more likely, and why? All right, a couple more quick community notes. If you're looking for that tighter, faster analysis, the premium group link is in the description. And if you want deeper, research-heavy breakdowns, that channel membership join link is there too. We've also had some behind-the-scenes updates recently. People joining, tiers shifting, access changing. Nothing dramatic, but if anything looks off on your end, keep an eye out for the fixes we roll through. I want the loyal viewers taken care of. And yes, we've got merchandise, normal mugs, wearable stuff. The whole point is supporting independent work without turning every video into commercials. Now, I'm going to land this plane by restating the thesis in plain English. Silver did not explode because one side cleverly trapped the other. Silver exploded because everybody is scared of being last to secure supply. China isn't necessarily trying to crush an American institution. An American institution isn't necessarily trying to crush China. What we're watching is global retreat into resources. Everyone is moving back to their corner. Everyone is hoarding. Everyone is acting in self-interest. And if that continues, silver can become a bargaining chip in much larger negotiations that also include copper, petroleum, and the minerals that run modern technology. Is that guaranteed? No. Is it worth thinking about? Absolutely. Because the right question is never what makes us feel comfortable. The right question is who benefits and who suffers. If you want more of these morning-style breakdowns, hit that like button, subscribe to John CV, and tell me in the comments what you want me to focus on next. Metals, energy, currencies, or the geopolitical angle behind all of it. And as always, I'm rooting for you to win, but I want you to win for the right reasons. Discipline, patience, and clarity. Also, if this rally keeps going, the next headlines won't be about price, they'll be about access. Pay attention to what happens when deliveries spike and inventories dip. I'm watching the spreads like a hawk. Stay sharp, because the quiet part is usually the loudest. One last thing. Everything you heard here is for education and discussion. I'm not your financial advisor. I'm not telling you what to buy or sell, and I don't know your situation. Use this to think better.